Hello, everybody. Luke Gromen, FFTT. Hope everybody had a great weekend. Gonna jump in here with our Sunday conversation, so thank you for joining me. First question comes from GR. If you would, please discuss in depth the path you see the fiscal stories taking. What percentage drop in the stock market would cause the collaboration needed to bail out Wall Street? I think the easiest way to answer this is say, look, history is very clear. Over the last 200 to 220 years, 52 out of the 53 countries that got to 130% debt to GDP like the U.S. reached last year, they had to either restructure their debt, their sovereign debt, or inflate it away. Especially when it's a twin deficit nation like the U.S. There's no case of a twin deficit nation not either restructuring or inflating away their debt. In terms of this happening, however, to your point, it's a very political process. So you need to have political cover, which obviously stock market drop is a very useful, convenient, has been used before. I would expect, to your point, that would be the cause. Again, my view is a 15 to 20% drop in the S&P from the highs would be enough to spur the Fed to stop and possibly temporarily, quote unquote, re-increase QE to reverse the taper. That, when you think about more Fed QE with ongoing federal deficits, that's effectively fiscal stimulus right there. My guess is you probably need a 20 to 30% drawdown, peak to trough, for more fiscal to scare Washington into providing more fiscal or extending existing fiscal spending that is slated to go away, whether that be student loan forbearance, child tax credits, etc. To be clear, though, I think, too, this isn't about bailing out Wall Street. 2008 was about bailing out Wall Street. From now on, this is about bailing out Washington, D.C. This is about bailing out entitlements. This is about bailing out 50 years of bad decisions, starting around the time of Nixon with closing the gold window, and any series of, particularly after 1989, after the Soviet Union fell, a big raison d'etre, reason for existing for a lot of the apparatus for the Euro petrodollar system. We should have restructured the system at that point. We didn't. And so we've made, particularly since 89, a series of horrifically bad foreign policy, economic policy choices that were all generally slated toward act now, pay later, act now, pay later, pull demand forward. And the bills come and due. And so that's what this is a bail. This isn't about bailing out Wall Street anymore. This is about bailing out all of us. So it's a little unsherry for right before the holidays, but it is what it is. Second question from TH. Jeff Snyder, as well as Lacey Hunt, denies QE as money printing. Do you still disagree? Yes. Ben Bernanke and Fed Vice Chair Stan Fischer, who was Bernanke's mentor, he was Draghi's mentor. He is the godfather, as one of my friends called it, as Harold Malmgren called him. He's the ultimate behind-the-scenes actor. This guy is tied in. They were both extraordinarily clear on this point. Federal deficits spent into the economy with the Fed engaged in QE is helicopter money, i.e. money printing. I don't think this is particularly controversial. The government hands money to people. Government issues a treasury to banks. Fed prints money, buys the treasury from the bank. There is a technicality that is a bank reserves. But again, it's already leaked into the real economy via the government spending. So unless the Fed is going to completely reduce their balance sheet, sell all those bonds back into the real economy someday, which they say they will, but they won't. They can't. Then it's money printing. If the Fed doesn't shrink its balance sheet back down to its starting point, it's money printing, full stop. And so 2008, Fed balance sheet was at $800 billion. Today, it's at $8.4 trillion. So unless the Fed's going to be able to reduce its balance sheet by, $7.4 trillion, sell those bonds back to the global private sector, which makes me laugh. There's no friggin' way, to be blunt. then that's money printing. De facto, that is money printing. So it's helicopter. You can read it in Ben Bernanke's 2002 deflation speech. You can read it from former Fed Vice Chair Stan Fisher in 2019 in the BlackRock white paper, August of 2019. Both of these are publicly available. Google them, find them online. It's money printing. It's helicopter money. It's money printing. Deficits plus QE is money printing. From Jeff G. If you had to choose fossil fuels or gold, and by the way, thanks so much for FFTT. I'll miss it the next 3 weeks. Thank you very much. You're very kind, Jeff. Fossil fuels or gold? Both. I want to own both. I think it's important to understand from two angles. Number one, gold is just energy. It's compressed and portable. Bitcoin is effectively the same. Gold and Bitcoin are effectively batteries in that way. Just compressed portable energy. Gold at the sovereign level, Bitcoin for the people. More importantly, if we take a step back and look at peak cheap oil and gas, which we're seeing, peak cheap copper, peak cheap, a lot of resources, which is becoming increasingly obvious if you look at the data and the amount of evidence piling up. It points to needing to that the commodities and neutral reserve assets should do well. Because ultimately, peak cheap oil and gas, and I'm just going to say that, peak cheap, a lot of commodities, peak cheap oil and gas means the death of the traditional 60-40 stocks bond portfolio that's done so well for the last 30 to 40 years. The reason that is that if the Fed tightens to try to fight commodity-driven inflation, then you're going to get a modest amount of deflation, but significant inflation at the back end, again, because you're not investing enough in energy and this other stuff like you should. Or if the Fed doesn't tighten and lets inflation run hot for a sustained period of time to both work down U.S. debt, but also to incent the global private market, the global capitalist market, to invest to address these higher prices, then you're going to end up with very high prices later, shortages later. We're seeing shortages around the world of stuff. This is no longer conspiracy theory, tinfoil hat stuff. We're watching it de facto in Europe, in Asia, supply chains on the West Coast, etc. So the Fed has a choice. Peak cheap oil and gas means the Fed has a choice. A lot of inflation on a sustained basis now, so that we don't have really bad inflation and shortages later, or the Fed can try to tighten for a little bit and fight this high inflation now and have really high inflation and shortages later. High inflation now or really high inflation later isn't good for bonds, either case. And so in that case, you want to hold a neutral reserve asset, not bonds, something that floats in value, a bond of finite issuance and infinite duration with a floating face value, something like gold. That's all gold is. It's a bond of 0% coupon, finite issuance, and infinite duration. And so you want to own bonds with 0% coupon, floating face value, and infinite duration. That's gold. That's Bitcoin, neutral reserve asset. So I think you want to own both for those reasons, both fossil fuels and gold and Bitcoin. From Valuable, in a tweet response to Macro Alf, you stated that other countries are not interested in treasuries anymore. Could you elaborate on this point? Could you also provide a point why that would not be the case? What Macro Alf said was the U.S. stock market represents 44% of world stock market cap, despite U.S. GDP representing less than 25% of cumulative GDP. Why do you think that's the case? And I answered, because the U.S. runs the world's biggest deficits, because we have to, because we're the world's reserve currency issuer. The world doesn't want nearly as many treasuries anymore, and if I had more characters in Twitter, that's what I would have said. I did say it doesn't want treasuries anymore, and so what the world's doing is recycling dollars back into U.S. stocks instead. And in plain English, what this means is that the post-71 structure of the U.S. dollar, Triffin's dilemma, which has always been known to be coming, is basically forcing the U.S. to trade ownership of U.S. stocks and real estate for cheap goods from China. So China sends us cheap goods, we send them dollars, and instead of buying treasuries, they buy stocks and they buy real estate. So the reason this is happening is just geopolitical and economic realities. Per the math I ran through before regarding negative real rates, etc. The math is clear. The U.S. cannot pay back its debt in anything resembling real terms. Again, once we get to 130% debt to GDP, 220 years of history, you restructure or you inflate. That's it. And with rates already at zero, basically, there's no way to pay back the debt in anything resembling real terms, especially when you factor in $100 trillion plus in entitlement obligations, which is just off-balance sheet debt. So treasuries have to be certificates of confiscation on a real basis. And unlike money managers who have to manage to a monthly mandate or a quarterly mandate, sovereigns don't have to manage to they can manage to a multi-year mandate. It's very nice for them. So foreign creditors just don't see the value in U.S. Treasury bonds. Why would you buy a bond that has to yield negative real rates just for the U.S. to keep the wheels on the car? And the answer is you wouldn't. You would buy stocks, you'd buy real estate, you'd buy gold, and that's what they've been doing. These foreign creditors have been doing that, and so you're seeing that in terms of rising equities, market cap as a percent of GDP. We've seen that consistently. You're seeing this. It's been in rising PEs. Obviously, corporate earnings are rising as well, but PEs are rising faster. And all of this is basically just a natural outcome, an early warning of U.S. deficit-driven inflation. It starts in equities and then it spreads out. So it also means that the dollar cannot be allowed to become too strong because foreigners are short dollars through dollar borrowing. So dollar gets too strong, they start selling U.S. equities to raise dollars, and the whole system goes into reverse, goes into a vicious cycle, and that sends the U.S., sends the world into recession. And a recession, when everybody's selling dollar-related assets, including treasuries, and the U.S. has record deficits to finance and debt to GDP of 130%, it's unsustainable. You can't do it. You would see yields on treasuries rise into a recession. It's called a balance of payments crisis when it happens in places like Turkey, as we're seeing in real time. So, over time, this turns the post-71 structure of the U.S. dollar reserve status is turning the United States into a global tax haven where the world buys our stocks. Plus, we have some cool tech, and we have shale, and we have farms. And that's an oversimplification, but that's what this drives rather than sort of a more balanced economy. Geopolitically, I didn't touch on that much, but adversaries like China, Russia, they would much rather buy gold in the case of Russia or U.S. equities and real estate in the case of China, along with gold, than they would own treasuries to finance their own military encirclement. From Nathan G., is there a practical difference between the Treasury minting $1 trillion coin and the Fed revaluing gold higher, or do they effectively serve the same purpose? Great question, and no, there's no effective difference. Both amount to a significant increase in the money supply without a commensurate increase in debt that could theoretically offset the increase in that money supply. Again, remember what I said earlier. If the Fed buys that debt and never sells it, it's money printing. It's effectively the same thing. But there's at least the credible thing that Snyder, Hunt, others can point to, say, well, that's debt. They're going to have to pay it back someday. Not if the Fed's holding it. Only if they want to. Only if it's politically convenient. And 12 years in running, 13 years in running, hasn't been politically convenient, has it, over the extended time frame. It's not going to be either for the next 10 years in all likelihood. Effectively minting the coin and revaluing the gold on the balance sheet of the United States, which then would deposit whatever amount into the Treasury TGA, Treasury General account. It's effectively the same thing. It's basically money creation without offsetting debt. And the final question from Peter: how did China manage to pop their equity bubble and keep it where they would like without causing recession? Why can't the USA do the same? China is a major surplus nation with a closed capital account. U.S. is a twin deficit nation with an open capital account and the reserve currency. U.S. deficits are recycled into the stock market in the way we talked about before. That increases foreign ownership of the U.S. stock market. Policymakers, as a result, in the U.S. have increasingly allowed the system to evolve such that rising equity prices help create tax receipts, consumer spending, global demand, and so it means U.S. government deficits need rising stocks to help fund. So it's a giant help fund it. So it's a giant circular, virtuous cycle, contingent upon stocks going up and to the right ad infinitum. So that and it's China and the U.S. are in the same boat. They're tied together at the hip with a very short rope. So it's if U.S. stocks fell, yeah, the U.S. will go into recession, but that ain't good for China either. I mean, it's going to drag on their economy as well. They've been desperately trying to become much more domestic consumption driven. They've made great strides in that. However, a U.S. recession would still hurt them tremendously. They still have a lot of capacity they have built that is export facing, and would be negatively affected by a decline in the U.S. stock market. So it's a virtuous cycle, but it's a virtuous cycle as long as stocks are rising. China can, in theory, have more leeway. They're less dependent. They're less acutely dependent on rising U.S. stocks, but they still are dependent. And China has other acute issues that the U.S. does not have around energy and water. So a lot going on. With that, this is going to be the last video update for 2021. It's been an interesting year to say the least, and I'm increasingly thinking 2022 may actually be a lot more interesting than 2021 in the broadest sense of the word, both fortunately and unfortunately. So let's watch for that. As always, if you like these updates, please check out what we're up to, FFTT-LLC.com. You can look into our tree rings product, which is 10 most interesting things, things that are grabbing our attention. Either they are surprising us positively, negatively, they make sense based on what we're seeing, they don't make sense based on what we're seeing, and always tying it back to different asset markets and sectors. So get a lot of great feedback on that. With that, I'm going to sign off. Everybody, I hope you have a wonderful holiday season. Merry Christmas, Happy Holidays, and Happy New Year, and we will see you all in 2022. Take care, everybody.